Well, hello everyone. Thanks for joining me again today. I really appreciate that. Today, I'm going to be talking about Crescent Point. Crescent Point Q2 2023. So thanks all for joining me. I really appreciate that. And maybe before we start, so I think I'll provide the agenda, I guess, for this conversation. I will share relative performance for the year and maybe the last couple of years, just compare it with some other companies. Then maybe we can take a look at their earnings, see how they've done in Q2, and then maybe evaluate kind of their conference call. So just listen to that, see what they've been sharing, and just listen to some other views from people that go on the TV, for example, and share some views about Crescent Point, and see what they're saying, just to make sure we have good understanding of the company, where they're heading, and what they were able to achieve so far. They did do a big deal. I think it was earlier this year. And so I think it's really worth our time to look at the balance sheet, really understand where the debt is at, what the current enterprise value, the cash flows, how much money, free cash flow they're generating, and kind of see their future plans and kind of go from there. So before we start, I'll just add a quick disclosure here, I guess. So the information that I share here is aggregated from the public domain for educational purposes only. So the idea is that I collect bits and pieces of different information or informations, I guess, from different sources, and consolidate for the viewer just to get a better understanding of those oil and gas companies that I cover. And my background is technical in nature, so I'm an engineer. I'm not a financial advisor by any means. So if you seek a professional advice or thinking about investing in companies or any other of the videos I've done, you're going to have to talk to a professional advisor, because I'm not one. And this should not be seen or understood or interpreted as investment advice, but it's for educational purposes only. It's really to help people, educate them on those companies and what they're up to, and the cash flows, and maybe give a little bit more insights towards some operations of those companies, and kind of add value that way, I guess. So the thing I would share right now, I'll present the relative kind of performance and kind of go from there. So at this point, what you should be seeing, okay, let's make it bigger so it actually makes sense. So right now you're looking at, so the company we're going to be talking about is Crescent Point Energy Corporation. The stock trades at $11.40. It's up today slightly, so you can see the date, August 11th today. Today traded below kind of average in the volume, but what we really care about is the market cap. So it's $6.1 billion, and in my understanding, just looking at the balance sheet quickly, their debt is about $3 billion. So the overall enterprise value is about $9.1 billion Canadian. And so they do have a dividend yield. It's about 3.55%. And you can see why this name is quite fascinating, is because it has this huge run since last month, going from $8.50 to over $11. So it's been $11.40. And so it's really important to understand why this happened. From historic context perspective, in 1 year, it's basically kind of been trading sideways. And over the past 3 years, you can see it had this tremendous run. It ran all the way up to this point. I think it was like $13 or so, and really kind of corrected back in June last year. And since then, it's been going sideways. But seems like recently we see this huge move. And so I think it's really important to revisit their earnings and really understand why this happened and what may be the catalyst for that. So as we look at the charts, the companies I chose to compare Crescent Point with would be Whitecap Resources, Meg Energy, and Baytex. And so this is kind of the relative performance, and you can see over the last 3 months, this tremendous run, basically from being down 10% to up over 20% in just 3 months. And on relative basis, if you take 1 month, you can see this really nice move. And so Baytex also had a very similar move, so you can see significant correlation there. But also over the past 6 months, this company kind of outperformed Whitecap, it outperformed Meg, and outperformed Baytex as well. And so I think it's important to keep those things in context within the time frame. As you can see here, it's kind of in the middle where Meg significantly outperformed all the other names. And if we look at the 3-year kind of time frame, we do see it's up significantly, 349%. But then it had this significant run with all other companies, really just to kind of really coming out of the kind of COVID downturn that was seen here, essentially. So over the past 5 years, all those names are up like 30%, except Meg up over like 208%. So as we kind of looking at this right now, I'll stop sharing the screen. Let's see what others are saying about Crescent Point and what kind of thoughts people, the Bay Street professionals have about Crescent Point. As I had mentioned, the name, around June 20th, it was at 850 or so, and today it's almost like 1150. So let's see what some people are saying. So Zachary Curry was on Market Call in BNN Bloomberg, and he shared that it's a quality company, and it's right-sized the ship, doing the right things. His view on natural gas and oil is positive. There is a concept of transition to renewables that it will take longer than expected, and I think we've been seeing a lot of news about that the transition that everybody talks about, it's becoming more of an addition of energies, not just transition. And natural gas is volatile, but companies are focused on debt repayment rather than drilling at all costs. And so they weather those storms. I think this comment is not really applicable maybe to Crescent Point, because they did grow the debt because of their acquisition. So that comment, I think it's more generic in nature and not really kind of appropriate in this specific case. So John Zachner was in June. He talked about Crescent Point. It was his top pick. He had mentioned that it's a very inexpensive on fundamental basis, paying down debt. Well, they do paying down debt, but they also increase the debt significantly, and restructuring assets. So returning cash to shareholders, okay, and trading at 3 times operating cash flow current strip price. He believes that oil prices heading higher, which they did. So good on you, John Zachner. You made the right call on oil prices. And the financial market's waiting on price of oil, but will pass. Cheap valuation, dividends will provide value over the years. Dividends will slowly provide value over the years. And as we had mentioned, Crescent Point, it's a 6.9 billion market cap company. It does have debt. So, but yeah, they do pay a dividend. I think it was like 3.5% or so. So he had suggested that it will slowly provide value over the years, which makes sense. Greg Newman was talking in June about Crescent Point. He said that have good shareholder return, over 11%, and cheap comparison to peers, trading at 4.4 times versus 3.3 times, and boosted production growth at 16% with some cash flow. They're paying you to wait with their dividend. Longer term is a go to Canadian oil name. So lots of endorsement here from Greg Newman. Another comment that was made by Ross Healy in June is he said that it's a powerful balance sheet, good dividend yield, huge upside potential, and cheap on price to book. He is sorry for the timing for the recommendation, but sees no reason to sell outside of here from trading sideways. And we did see that it kind of traded sideways here, and it was his past pick, but it was down on kind of the decline, essentially. So, which is fascinating. Back in May, Eric Nuttall talked about the name. He said that a cheap valuation, high free cash flow, aggressively buying back stock. Downside is inventory depth, but recent acquisition and drilling have rectified this. You can see the name much more than 3. Yeah, he can see the name much higher than 3 to 4 months ago or so. I think, in my understanding, that's kind of what was shared, but in overall positive and with a buyer recommendation. And that's about it. That's all I wanted to share when it comes to kind of what others are saying about this name, and maybe right now kind of look towards their quarterly earnings and kind of go from there. So right now I'll present the quarterly earnings. Okay, here we go. So you should see lots of text right now, but we're not going to be looking at lots of text. We're mainly going to kind of look at tables and what was disclosed. So this is Q2 document for Crescent Point. And what you can see here is essentially, so let's start kind of from results and operations from this table. So their production right now, total BOEs, right? So they produce natural gas liquids, natural gas, and crude and oil condensate. So you can see significant increase from 2022 for Q2. And in overall, this is like 6 months ended June 30th. You can also see an increase here if you take the 6 months, and it's kind of, they basically combine the Q1, and there is a 5% change in overall. So that's very positive. Natural gas liquids. So natural gas liquids, you see basically 18,900 here production in Q2. It was about 16,000 in Q1. Oh, sorry, in Q2 in 2022. So another increase eventually, and huge uplift in natural gas production clearly here. And so they basically go in increasing production, I think, through acquisition year from 129,000 or so to 155,000. And so crude oil liquids and natural gas partitioning is about 7822. So this name, in one of my previous videos, we covered ARC Resources. ARC Resources, from what I remember, it was 63% kind of natural gas and about 37% liquids. And so here we see almost like a flip of it a little bit. We see more crude oil in liquids, and natural gas is 22% or so. That partitioning kind of through the acquisition they made changed from 2022, where it was a little bit higher liquid rate, but you can see significant increase in natural gas production. So if we want to kind of look a quick overview of the company, the second quarter results were highlighted with closing of its strategic 1.7 billion Alberta Montney acquisition in May 2010, and that explains a lot, right? So when we see debt increasing, this is because they acquired more barrels in Alberta, right, in the Montney, and the company acquired production of approximately 38,000 BOEs per day and 235,000 net acres in the Montney rights. Production averaged 155,000, as we had mentioned, primarily attributed. So 1 second here. So 3 months ended June 2023, up 20% from the second quarter of 2022. So that's kind of the increase we have seen, primarily attributable to Alberta Montney acquisition, as well as higher volumes in the Kaybob Duvernay, partially offset by the downtime related to Alberta fires. The adjusted funds flow from operations is $552 million. Earnings from operations is $205. And despite weaker benchmark crude oil prices, the company continued to maintain strong operating netback of $41 and excess cash flow of $278 million or so. So as we kind of, so let's see here what's important. Okay, so here, Crescent Point continued to execute on its return to capital framework during the second quarter, returning $166.7 million or 60% of excess cash flow to shareholders through share repurchase and dividends. And I think it's important to keep this number in mind because if that's the number they committed to, and let's say if we take 4/4 of those type of numbers, so let's say 167 times 4, so we get 668 million, and we divide this, let's say, by 9.1 billion. So we get about 7% free cash flow yield based on that. But maybe there is a little bit more to that. As the oil prices continue to increase, maybe they're able to return more to the shareholders. So that's kind of an exciting development. But instead of reading the text, let's look at the tables and let the numbers kind of speak to themselves. So what you're seeing here right now is essentially production by area. So this is more kind of, again, for education purposes. So let's see what regions they produce the oil from. So Saskatchewan, they produce 63,000 or so, and Alberta 68,000, and North Dakota 23. So there is an American operation here. So in overall 155,000 barrels, right? So that change increased from 2022. It slightly declined in Saskatchewan, significant increase in Alberta and North Dakota as well, as seen here. So that kind of gives you a perspective of where the focus is going. This is production on, as we, I think, talked about, when it comes to crude oil and condensate, natural gas partitioning, and NGLs. So you can see, basically, we talked about this in the form of the table, but kind of how they relatively kind of compare in liquids production as total percent of total production. So 78% right now. This table is kind of useful because it talks about the average selling prices, and so marketing and prices, crude oil and condensates. So essentially, you could see the comparison of what happened in Q2 last year, which was a record quarter. You may recall that, unfortunately, Russia attacked Ukraine in Q2, Q1, I think it was, end of February 27th, 2022, unfortunately, and obviously, Q1, Q2 were very strong quarters when it comes to the oil prices as they continue to increase. And you can see kind of the relative crude and oil and condensate average selling prices. It used to be 134, now it's 92. So significant uplift, in 2022, but really great prices even in 2023. NGL down roughly 50% here on the average selling prices. And obviously we know about natural gas. Dollars per MCF going down from $8 to $2.80, but total, not netback, but selling price, I guess, would be 67.3 and 109 in Q2 of 2022. So this is something important to be mindful of. And here we can see benchmark prices as well for WTI crude. What I really love about Crescent Point presentations is they always give you a little bit extra to kind of learn about the company. I covered this company in Q1 2023, and they kind of just continue with those slides. And I don't know why others wouldn't do something like this, because it really helps you better understand what were the prices and make your calculations on kind of estimated sensitivities and free cash flows, and kind of the netbacks associated with different productions. But kudos to Crescent Point for providing this information for us and allow us to learn more from kind of what they share here. So basically for 2023, for 3 months ended in June 30th, so Q2 2023, the WTI crude price average was $73.75, and it was $108 because of that increase in oil prices in Q2 last year. And WTI crude price in Canadian dollars was close to $100, was $138 in 2022. Those are the big numbers. Now, what's unique about Crescent Point, and I really love this about presentation, is that they have LSB crude oil price. You can see the kind of the differential to the WTI prices, right? So you basically subtract that number from the benchmark. So LSB stands for light sour blend crude oil price. FOS, and they sell in FOS as well, stands for Fosterton crude oil price, which typically receives premium and Western Canadian Select WCS. UHC here, it trades at a slight premium. It's the sweet at Clearbrook crude oil prices. MSW is the mixed sweet blend crude oil price, traded slight discount, and C5 condensate. It refers to the condensate Canadian C5 plus condensate index. So AECO, obviously, we know about AECO, is the Alberta Energy Company natural gas prices, and NYMEX, obviously NYMEX is the New York Mercantile Exchange natural gas prices. And so I think I really love this table because it really shows you sensitivities and the relative percent change. And I think what's really important here is if we look, let's say, what could be meaningful here? Let's say at AECO, right? The daily spot natural gas prices look 245, 724. That's a significant reduction. I think it's 66% reduction. Same with NYMEX natural gas, right? So those companies, they have to be very strong when it comes to kind of having a low cost of supply, being able to compete at lower prices, and basically getting a lot of momentum in collecting those extra margins when they generate significant cash flow when the prices are much higher. So this is very powerful. And here you can see how the crude oil and condensate stream exposure for Crescent Point changes, and basically what they get based on LSB, FOS, HC, C5 plus, and MSW. And like we talked about, they have a little bit more exposure now to MSW. They have same exposure to condensate. UHC is up a little bit. FOS is almost the same. And there was some decline here on the LSB. And you can always refer to this table here when it comes to what it stands for. So light sour blend for LSB, FOS, Fosterton crude oil price, and see the associated prices and discounts or premiums to the benchmark price. So this will be the crude oil and condensate prices. So you can see here basically in the table exactly what we shared. So they had this partitioning basically in kind of the circle and how they partition. And now they plot the prices against versus time. And you can see here maybe some momentum around FOS, but everything pretty much here kind of moving as we described in the table as well. And this is crude oil and condensate prices U.S. operation. In U.S. operations, and this is Canadian operations. So very important to kind of keep this in mind. Okay, so maybe moving, so we kind of covered, I think, some of that. Operating expenses. So operating expenses a little bit down here in millions, so that's good. You can see transportation expenses, they're up in, I think we've seen before, transportation expenses are up for many companies, but operating expenses are slightly down here. So operating expenses used to be 180 last quarter of 2022 and 203 million in 2023, in Q2 2023, and this is kind of the 6 months combined information. So the change is slight increase here. From the 6 months, but also increased to 203 to 180. So let's see why this is lower here per BOE. So this is essentially flat here, and this is per BOE. As you translate this per flowing, you get slightly less operating expense. So this is interesting. All right. So let's see kind of the netbacks portion. Oil and gas sales, total dollars per BOE, $67. Used to be 109 Q2 2022. Royalties, seems like royalties are down. Operating expenses look to be down. And again, we're comparing to Q2 2022. Transportation expenses seem to be up a little bit, so that's okay. And here we get $41 operating netback and $76 last year. Netback, if you take realized gain on commodity derivatives, so essentially 54 here, so that was a little bit of a hit last year, but 42.80 here netback for this year. And maybe that's why the market kind of realized that the company is doing quite well when it comes to the netbacks and rewarded it. And that's why maybe we've seen this outperformance. G&A looks normal here, very, very small dollars, so we're not going to focus on that. Interest expense on long-term debt. Yeah, so this is important, right? Because the debt increased in my understanding. So this will be the interest expense on long-term debt. Kind of translates to a little bit more than $30 million here. All right. I really want to get to this overall table when it comes to there's this really good table that I wanted to share and kind of focus on that. Just bear with me here. Yeah, here it is. So this table is the summary of quarterly results and here this is why I wanted to focus on that, because there is a big change here, and this change just correlates with the acquisition that was made in the Montney, therefore increase in production, but also increase in debt. And I think we're going to have to cover that in a little bit more detail, and that's what I wanted to cover. But yeah, so when it comes to oil and gas sales, everything here in million, 949 million versus 913. So again, the stock could have been rewarded for increase in the Q2 numbers when it comes to oil and gas sales in millions of dollars. If we compare this to Q2 last year, you had significantly higher prices, but maybe there were some kind of hedges that hurt them or something. And this number 949 is not far away from Q4, Q3, Q2 last year, and Q4 in 2021. And so I think maybe that's why we've seen such significant uplift in stock price, going from 850 to 1170. Yeah, 1144. And yeah, you can see it in the numbers. It's very close to $1 billion here, so that's good on them. So average oil production, as we discussed, we already covered that table, but essentially it's 155,000, going from 139. So let's see historically what the production have been. So in 2021, Q3, 132, 130, 132, 129, 130. So essentially no decline for a year and a half. Then they increased production here into Q1, and then acquisition, obviously 155. So this is fascinating, really, really good in them. And so when it comes to net income, they did have a loss in Q4 here, but otherwise, 212 to 16. So maybe the market expected like lower income, I guess, from Crescent Point because the oil prices declined, but seems like they were able to basically meet Q1 type of numbers, which is great, right? And so this is much higher than 2021 timeframe, and obviously Q1, Q2 on the income side was significant there, but the oil price was also like up significantly, so that makes sense. So let's look now at cash flow from operating activities, 462, 470. Again, this is in line with Q1, very close, right? So maybe the market did not expect that, and that's why Crescent Point got really rewarded when they announced their earnings. Adjusted funds flow from operations, 552, much higher. Adjusted fund flow, which is when you subtract the capital expenditure, you get the free cash flow. So here it is, 552 versus 524. Yeah, but then again, production increased, so that makes sense. Net debt. So net debt, $3 billion. And this is the one thing, going into the cycle, people will have to kind of consider that the debt used to be, clearly from 2021, a lot of the free cash flow was used to pay down debt. This is very obvious here, where, you go into $2 billion debt, $2 billion debt into 2022, the oil prices are very high, and you're like really committed to cutting debt. So you do that 225 million here. Then you go for like over 500 million debt reduction since the beginning of the year. Then you cut more. You could almost obsessively cutting debt, and then you're like, okay, wait a second, we have this opportunity, and then you go back to $3 billion, right? And so, as we said, market cap was 6.1. The debt level here is now 3 billion. So let's calculate on the per flowing metric according to current production. And obviously this number is going to change. It's going to change significantly because maybe if they increase production or the stock appreciates, or maybe they're buying back shares, something will change. But seems like here they trade close to 59,000 per flowing. 58.7. So that's kind of based on this calculation. Don't take my word for it, but please. And if you see me making a mistake, or if something doesn't make sense to you based on what I just shared, just message me or make a comment so people know. So we share the truth about the numbers, and everything is clear to whoever is interested in this company. And so I think we did a good job kind of covering everything we wanted to cover. Obviously, they have dividends declaration here, right? So $54 million in dividends. You take the share numbers, and when you look at the dividend declared per share, is about 10 cents, which is much higher than the previous quarter, and maybe that's why they also got the stock price also appreciated when they report their earnings, because maybe the market did not expect that. So, but yeah, and overall, they're really fascinating company. A lot going on. Obviously, it's an oil kind of more oil tilted company, and so I think what could be a good opportunity right now is for us maybe to listen to their earnings call and try to better understand kind of what management is all about, and kind of go from there, and maybe give them an opportunity to kind of explain and showcase their company. So I'm really looking forward to it. So I'm going to share this right now. So let me take a look. All right, so it looks good. Let's introduce the play button here. Here we go.
Executive Officer at Crescent Point. Please go ahead, Mr. Brixa.
Thank you, operator. I'd like to welcome everyone to our second quarter 2023 conference call. With me today are Ken Lamont, our Chief Financial Officer, and Ryan Gritzfeldt, our Chief Operating Officer. As the operator highlighted, this conference call is being webcast along with a slide deck, which can be found on our website. Today, we're introducing a new format to our conference call to add a level of further engagement and to turn the call into more of a discussion on our forward outlook. Earlier today, we issued our quarterly press release, financial results, and updated corporate presentation, each of which can be found on our website. During this call, I'll provide a brief strategy update, highlight our strong quarterly results, and discuss our overall outlook for the remainder of the year. We'll then move into a Q&A session. We will start by taking questions over the conference line, as we usually do. And once those questions have concluded, I'll then turn the call over to Shaunavon, our Vice President of Capital Markets, who will moderate questions from participants joining us on our webcast. We encourage those in our webcast to submit questions using the chat function on the online portal. We look forward to the discussion that this format will provide. So let's get started. On the strategy front, we significantly advanced our portfolio optimization through our successful Alberta Montney acquisition during the second quarter. This transaction materially enhances the quality of our portfolio, both in terms of our depth of premium inventory, as well as our excess cash flow profile and our return to capital per share. This acquisition is consistent with our strategy of pairing quick payback, short cycle assets, such as the Alberta Montney and Kaybob Duvernay, with our longer cycle, low decline assets in Saskatchewan. This mix of short and long cycle plays results in significant excess cash flow for the company and our shareholders. It also allows us to execute on our strategy to generate sustainable long-term returns through a combination of per share growth and a compelling return of capital offering, all while maintaining a strong balance sheet. Our multi-basin approach remains strategically focused on oil and liquids, which account for 75% of our current production. By remaining dedicated to this approach, we are able to deliver on one of the highest cash flow netbacks in the industry, along with significant excess cash flow per share. We are successfully integrating the new Montney asset into our portfolio and have a near-term goal of further enhancing our returns through additional productivity gains and cost efficiencies. Part of our early success in this play has been the result of our efforts to leverage our existing relationships with our suppliers to reduce our costs. We have also identified additional areas for potential efficiencies, including ongoing well completion optimization, deploying longer lateral lengths, and shifting to larger multi-well pads. As you can tell, we're excited about our new Alberta Montney position, especially given its recent prolific well results. For example, 4 of the top 5 liquids wells drilled in the Western Canadian Sedimentary Basin in May were our wells in the Montney, highlighting the attractive reservoir characteristics and the scalability of this asset. We have continued our drilling success into June, achieving impressive results that are in line with or exceeding our early well results. Like the Kaybob Duvernay, our Montney play provides the opportunity for new reserve additions and ultimately net asset value per share growth, given that only 25% of the locations we have internally identified have been booked. This transaction, along with our strategic steps we have taken over the past few years, has allowed us to build a very strong profile or portfolio that is well positioned to generate long-term returns for our shareholders. I'll now shift to our quarterly results and the execution across our portfolio. During the past quarter, we continued to demonstrate our operational excellence as reflected in strong performance of our Kaybob Duvernay assets. I'd note that our second quarter production of 155,000 BOE per day included the impact of approximately 7,000 BOE per day of downtime associated with the wildfires. First off, I'd like to commend our teams in the field and thank our local community members and first responders for their incredible efforts to keep everyone safe during the wildfires. Furthermore, thanks to our dedicated teams and advanced field operation technology, we were able to quickly restore our Kaybob Duvernay volumes as the fires subsided. These wildfires masked our true outperformance in the quarter, which was driven by our Kaybob Duvernay assets, with recent on-stream production outpacing our type wells in the area. Due to this outperformance in the first half of the year, we have kept our annual production and capital expenditures guidance unchanged. Our second quarter results also demonstrate our commitment to returning capital. During the quarter, we returned $167 million, or approximately 60% of our excess cash flow, directly to our shareholders. This included $93 million of share repurchases in addition to our dividends. In total, we have now repurchased for cancellation nearly 17 million shares year to date and remain active on our buyback program, which is the tool of choice within our return of capital framework. Over the past 12 months, we have delivered more than $550 million to shareholders, marking our 4th consecutive quarter of returning approximately 60% of our excess cash flow. I'll now touch on our outlook for the remainder of 2023, along with our 5-year plan. During the second half of this year, we expect to realize the benefits of our recent Montney acquisition and continued momentum in our Kaybob Duvernay play, as we plan to bring on stream additional pads in both areas during the third and fourth quarter. Our second half 2023 production is expected to average approximately 179,000 BOE per day, generating over $1 billion of excess cash flow on an annualized basis, assuming a $75 U.S. price deck. As we look further out, we expect to generate $5 billion of cumulative excess cash flow under our 5-year plan at similar commodity price assumptions, providing a combination of disciplined per share growth, attractive return of capital, and further debt reduction. We plan to provide our preliminary 2024 outlook later this fall alongside an updated 5-year plan. Lastly, on the ESG front, we remain steadfast in our commitment to strong environmental, social, and governance practices. During the quarter, we released our 5th annual sustainability report, highlighting our strong ESG performance and detailing our key ESG initiatives. I'm proud to report that our environmental initiatives over the past 5 years have resulted in a reduction of approximately 50% in both our Scope 1 emissions intensity and our asset retirement obligations. We also continue to achieve record safety scores, which speaks to our safety-first culture. I'd like to thank everyone for their continued support and engagement, in particular our staff, who continue to deliver on our purpose of bringing energy to our world the right way. We'll now open the call for questions from the analysts and follow with a Q&A session for those on our webcast. Operator, please open the call.
Thank you. As a reminder for members of the investment community, if you'd like to ask a question, please press star, then the number 1 on your telephone keypad. If you'd like to withdraw your question, please press star 2. We will pause for a moment to compile the Q&A roster. For those on the webcast, please use the chat function to ask a question. Your first question comes from Dennis Fong from CIBC World Markets. Please go ahead.
The solid quarter, and thanks for taking my question. The first one that I have is just related to Montney. There's a lot of discussion around Gold Creek East and West. I was just curious as to some of the potential development plans around Carr, just given also attractive economics in that region, or is there any kind of, I don't call it hindrance, but things that you need to complete before further developing that region?
Hey, this is Ryan here. I'll take that one. So yeah, Carr. Obviously, it's an area that we really like. It's obviously a little bit more higher oil percent, higher liquids percent than Gold Creek. Not as many future drilling locations there as in Gold Creek, but we do like the area. We finished drilling a pad there when we took over from Spartan, and actually right now fracking a pad there, which we should have results to disclose next quarter. But yeah, we are drilling there for the rest of this year into 2024, and of course we'll continue as we get locations ready. But yeah, we just haven't talked about Carr yet because we don't have any results since the close of the acquisition. But we are fracking a pad there as we speak, and we'll speak to that next quarter.
Great, thanks. And my follow-up here is also on the Montney here. You've obviously talked a lot about optimizing both cost structure and even completion design now that you've taken over the property. What would maybe drive a decision and or timing to add a second rig in the Montney, and kind of what are you looking for to help drive the confidence around accelerating capital deployment into that region? Thanks.
Hey, Dennis, it's Craig here. Thanks for the question. So obviously very excited with the results we've been seeing to date and bringing that acquisition now and having it in-house, and our technical teams really been able to spend the time and dig into it. So the more we get in there and the more we work through it, the more excited we get about this. And you can see that as the results are coming out here over through May and into June, and what we were putting here into our quarter. So on all fronts, it looks really good. I think as the technical team gets into it, we'll do things a little bit differently like we did in the Duvernay. If you remember when we picked that up, we moved in there with purpose. We got smarter over, call it, the first couple of years of owning that asset, and now are moving the second rig into the Duvernay here in October of this year. So look for us here to do it in a similar fashion, Dennis. We're gonna spend some time. We're gonna get active in there. We're gonna do what we think is right as far as landing the wells in the landing zone of our preference. We're gonna change up some completion design, ultimately really maximize some height growth within there, and then ultimately that should show through in the results. So as we think through our 2024 program, right now it's sitting at one rig in the Montney, but if there is capital shifts across the portfolio, I would expect that to be moving into the Montney and maybe out of other areas. But I wouldn't expect anything over within the next 12 months, Dennis. So right now it's a one rig plan here. We'll see how things play out as we get smarter and really test what we want to do. And again, this is where I get excited about it, Dennis, is because you think of our technical teams within this organization and what they were able to unlock in the Duvernay and now parlay that into the Montney. I guess that's a long-winded way of me saying that nothing here incremental in the next 12 months, but over that, when we get beyond that and we're a little bit smarter, look for us to start shifting some capital.
Great. Thanks, and appreciate the color there, Craig. I'll turn it back.
Yeah. Okay. Thanks, Dennis.
We have time for one more question coming from Travis Wood from National Bank Financial. Please go ahead.
Yeah, thanks, and good morning. Wanted to talk about divestitures and with a few things in the fire, and just assuming that something closes across the portfolio here over the next several months. How are you thinking about the allocation of those proceeds, maybe just from a debt, variable, special, and base dividend perspective, but then also, how are you, as you look at opportunities and kind of future business opportunities, and you evaluate those, how are you ranking those future opportunities from a conventional oil or oil sands, liquids rich perspective, as you look at future inventory expansion from a M&A perspective?
Thanks, Travis. So it's Craig. I'll take this one, and if Ken and Ryan or Sean want to add any color, feel free, gents. But so, Travis, obviously a lot of work in the last 5 years of what we've been doing as far as building out our portfolio. I can tell you how we sit today. We're extremely excited about what we have, especially when you think of the short cycle and the long cycle pairing, like we've talked about quite a bit in the past. And really 2 premium North American unconventional resource plays paired with our Saskatchewan waterflood assets. So really love the balance in the portfolio. We love the weighting that we have in the portfolio, particularly when you think of us at around 75% liquids. And at the same time, now on the back end of this transformation, we have a premium inventory of 15 years. So we're sitting in a really good spot and feel really good about it. Your question is as far as dispos. We have talked in the past that there's maybe some things that don't necessarily fit with the build out here the long term, and we'll look to move off a piece of that or a piece or two over time, and we'll see how that plays out. And I would tell you, as happy as we are with how things have come together and the balance sheet, our balance sheet strength at only kind of 1.4 times debt to cash flow here, and that should be around 1 times at the end of this year to call it a $75 deck. So balance sheet is strong, Travis, but I would expect the proceeds of any of those sales to be earmarked for near-term debt reduction, so to further strengthen that even more. And then to your comment around what does the portfolio look like going forward, Travis, again, very happy with where we are. I would tell you, our sandboxes are fairly well defined right now. Don't look for us to expand out of where we are in between Kaybob and Montney, the Alberta Montney, and then into the Saskatchewan waterfloods. I would say our sandbox is fairly well defined on that front. So, we'll see how things play out. Happy with how things are. Absolutely in no rush to do anything on an A or a D front. It's been, we've spent the last 5 years really building this out and extremely happy with where we are.
Okay, that's great color. Thanks for that. That's all for me.
Okay, thanks, Travis.
There are no further questions over the phone at this time. Craig, please proceed.
Okay, I'll pass it over to Sean. I think he has a few questions here coming in line.
Yeah, thanks, Craig. A couple questions coming in as we've been chatting. One or a couple still around cost front. One asking if we're continuing to see any cost pressures, and someone else seeing if we're actually seeing any cost easing. So maybe we can give a little bit of an update on that front.
Yeah, that one is probably best for Ryan to speak to.
Yeah, I would say in general we're seeing a flattening of costs and rates, coming out of the recent inflationary environment here, probably led by reductions in casing, steel, tubing costs, but probably cost pressures still remain more on equipment utilization, labor costs, etc. But with that, we're keeping our current cost estimates status quo, puts us kind of right in range of our 2023 capital budget of 1.15 to 1.25 billion. I would say a couple exciting things, upon the close of our acquisition, like Craig said, in the Montney, we had our Gold Creek type wells at around a $9 to $9.5 million per well range. We've quickly, after really only operating there for 2 months, been able to leverage our existing supply chain, our current service partner relationships. Already reduced our casing costs, reduced some of our frac costs, specifically, on sand sourcing, and so already have line of sight to sub $9 million well costs there. So, that's one thing that I'd highlight and something that we're really excited about.
Thanks, Ryan. A couple more questions here on return of capital. I'll probably break it up into two. One, someone's just looking for clarity. It looks like our return of capital payout, they're questioning whether or not we increased it from 50% to 60%. So we can give some clarity there first. And then the second question, someone's asking if we are looking at or would consider increasing that return of capital payout or perhaps accelerating buybacks to narrow the discount to that.
Sure, maybe I'll take this one, Craig. It's Ken. No, our framework hasn't changed. Our total return of capital is really comprised of two parts. One is the base dividend, and the other is a return of some discretionary excess cash. And really, the 60%, what we've done here is just simplified how we present it. We're doing that now in aggregate return of capital as a percentage of excess cash. And that really now just makes us more comparable to our peers when you're sort of comparing our return of capital proposition relative to peers. So I guess that's the first part. It has not changed. And obviously, we're proud of this framework. We've been following it now for this is the fourth quarter. So the second part of that is no, we don't have any plans to revisit the 60% return level. I think this really strikes a healthy balance between, a competitive return of capital, as well as allowing us some access to capital to reinvest in the business and to repay debt. So no, we don't have any plans to revisit the 60%.
Okay. Another question around hedging. Any plans to lure more hedges in for 2024? And just someone asking particularly on why dips in Q4 23.
And you're probably best to speak to that as well.
Sure. So just as a matter of an update, we are about 25% hedged now through the second half of 2023. So I think we built a pretty solid book there, and always just looking to enhance it a little bit. But I would expect us probably not to get past the 30% level. As we look into 2024, we've actually started a program now into 2024 into the first half. So we're going to start chipping away at hedging there. We are looking to kind of get hedged out about a year out in that 20 to 30% level. And obviously, still fighting a little bit of backwardation as you get out a year out here now. And so we'll be patient and disciplined. And as this market moves up, as it has done in the past week here, we'll look to take advantage of that.
Thanks, Ken. Market access related question. Can you talk to CPT's relative market access position and if Trans Mountain coming online soon will help in any way?
You want to grab that, Ryan?
Yeah, sure. Yeah, obviously, Trans Mountain coming on definitely helps egress out of the basin. We don't have any volumes earmarked for that pipeline, but definitely, will open up space. And, you'd have to think that differentials, for most products, hopefully, especially, our products out of the Montney will strengthen significantly with that. So, I think that's definitely a positive for industry and, hopeful that will help realize pricing go forward.
And the only thing I'd add on that is when you look at our portfolio, we have a very good position as far as where we sit on the Enbridge main line. So on that front, takeaway for us is a strength. I would also say as we look at assets and in particular what we like both the Montney and the Duvernay acquisitions that we've done over the past few years is just the takeaway or the flexibility around the takeaway out of those assets. So that's certainly a criteria we look at is ensuring that we always have that market access.
Thanks, guys. Another question here back on Montney, Gold Creek West. Why are you seeing Gold Creek West results stronger than Gold Creek?
Yes, I'll take that, Craig.
Yeah.
So yeah, I mean, Gold Creek East still, very good. Our results are on type well there. 3 of the 4 wells that, were in the top 5 of the top Alberta liquids producers in May are Gold Creek East. So really on type well there. I think what, we're obviously most excited about are the Gold Creek West results we're getting. I would say, based on all the work our teams have done, geomodeling, reservoir, petrophysical, when you look at the outperformers in Gold Creek West, still early days there, but we think kind of like what we did in the Duvernay was wells that are landed at the bottom part of the reservoir are getting the best results. And so we think that the way we're going to frack these wells, we can access all of the net pay by drilling a single bench. And so that's we think is going to be the most capital efficient way to develop this area. The results we're getting, and they're worth repeating because they are significant. The first well, 1900 BOE a day, 80 plus 85% liquids. It's also the IP90, so that well is hanging in there. The first pad that we fracked, the two best wells are averaging 1600 BOE a day, and then the second pad that we fracked at only 15 days production, we're over 1000 BOE a day, 80% liquids already. And so obviously very excited about that area. Recall that 300 locations of the 600 locations that we identified in the acquisition are in this Gold Creek West area. Less than 20% are booked. And also recall the type well, the book type well is only 1000 BOE a day IP30 at like less than 60% liquid. So obviously, we're really excited about this area. I think a ton of upside. And like I said, with only a couple months operating so far, we've already seen, well costs, path to get to sub 9 million. And, we'll continue doing that as we trial, different drilling techniques, different bit technology, as we continue to drill here. So obviously really excited about that area and what it can do in our 5 and 10 year plans.
Thanks, Ryan. Another question, just going back on the M&A theme. You guys have clearly grown in the Montney and Duvernay, and you've defined your sandbox. Is there more opportunities still to do on the conventional oil side of the business back in Saskatchewan?
Yeah, I think, like anything, we'll always look at opportunities that are in front of us, and you never know what's put in front of you, and we certainly will do our homework and look at it. I just double back to what I was saying earlier, that we've done a lot of work strategically as we've repositioned the company here over the last 5 years, and extremely excited about where we're at now and the pairing of the two North American premier resource plays with the Saskatchewan water floods. It's got us extremely excited, especially when you think of the balance within the portfolio. So certainly we would look at doing it. I would say again, though, I'm going to double back to earlier. Don't expect us to go outside our sandboxes. Our sandbox is extremely well defined, and we'll see again how it plays out here, over the next 12, 24, 36 months on those things. But very content with where we are today, and feel really good about not only the 5 years in our 5-year plan, but the next 10 years on how that looks for Crescent Point and what that means for everybody, in our shareholders, our employees, our staff. There's a lot of excitement now around this table. So feeling really good about where we are.
Thanks, Craig.
Mm-hmm.
At this time, there's no additional questions from those listening online or no one on the phone lines as well. So thanks for everyone for joining our call today. And if you have any follow-up questions that weren't answered, please call our investor relations team at your convenience.
Thanks, everyone.
Crescent Point's Investor Relations Department can be.
Okay, well, thanks so much for listening to this. And I think we got some key clarifications here about certain things and their plans to growth. One couple of things I wanted to make a correction on maybe. So again, we're talking about market cap 6.1 billion or so, 3 billion in debt. And seems like the production they had in Q2 was affected by the wildfires. So they basically guiding now close to 180,000 barrels a day, I think. So about 178,000 or so. Please review their presentation again if my memory doesn't serve me right. But they reported 155, and the production is expected to grow a little bit more. So then on the per flowing metric, it should be about 50,000 per flowing. So that's kind of a correction I want to make based on kind of our assumption that increase in production was typical, which we now know it's not. So it's about to grow even more. And it seems like the management team been communicating that when it comes to M&As, and that they're very happy be in their sandbox. I think there was a comment associated with hedges. I don't know if it's common knowledge in our community, to be honest, that Crescent Point hedged here at 25% and would be hedging maybe closer to 30%. So this is, I think, significant value add to the listeners. And, to be honest, this company been hedging in the past as well. I think 2022, they had hedges as well. So something to be mindful of. So overall, just to kind of conclude where we at and kind of what we discussed when it comes to their Q2 results. I really enjoy Crescent Point's presentations here because they make things a little bit simpler, kind of to explain and kind of to basically the summaries are easy to understand and the numbers are making sense. So that's good. So very grateful for that. At the same time, like as I mentioned, they produce 155,000 barrels a day, BOEs per day in Q2. In Q1, they produced 139. So based on Q1 production, they expect an increase in production rate in BOEs per day relatively to Q1. So prior to acquisition is expected to grow by roughly 40,000 BOEs per day. So that's something very exciting. So a couple of things to look forward to is perhaps the debt levels here. The dividends declaration they're going to have maybe in Q3 based on the free cash flow they're going to be able to generate, as well as kind of return of capital. And I think the management team did a good job describing that. So very grateful for this space. Hopefully you guys got a lot of value. So we have, for those of you that don't know why I'm doing this, we have a community on Twitter. My handle is Razor Oil. So I cover companies, all kind of oil and gas companies, and making kind of videos about the companies and trying to simplify the stories, both on Twitter and YouTube. So I do those lives once in a while. So hopefully you enjoyed. And if you did, like and share with others so we can kind of create more awareness and education when it comes to these companies, these oil and gas companies, energy companies that that provide safe, reliable energy to society based on society's demands. So this is very exciting, and great quarter by Crescent Point. They clearly got rewarded for this quarter, and looking forward to hearing more about this company in the future. And if you have any thoughts, any corrections, anything you want to share, please let me know. And again, just to reiterate, this information was aggregation, all kind of information from public domain for educational purposes only. If you have any questions, as seen here, based on the Crescent Point presentation, please contact them. And I'm not affiliated with this company by any means. And do your own due diligence when it comes to investing and investing strategies. So all the best, and we will talk soon.